let's say, give it a year. Because I mean, this stuff is moving fast. With an AI agent, I think we're not going to see that level of adoption, that level of acceptance, that level of awareness with AI agents, utilizing AI agents for crypto for quite a while. Maybe I'm wrong. What do you think?
I think where it's most likely to show up in the next year is it's going to be a lot of the people that are trading and making money, kind of making markets in the space, are going to use these more advanced bots to deal with cross-chain liquidity solutions or look for arbitrage across different exchanges or across different chains and everything. That's probably where that's where I think it'll probably show up.
That's
That and
interesting.
there's always, of course, going to be tokens associated with some of these agents.
That's
And
true.
when something's new and it's got a lot of
Yeah.
hype like this, the other place it'll show up is at the top of the charts in terms of like
Yeah.
what's going up in market cap.
Yeah. I kind of feel it'll almost be a shame if that's the in for most people. But then I guess, that's an education as well. It's an on-ramp for what this stuff is all about. You do get just the sort of like the outright degens just buying whatever, right? I mean, we see that every day in crypto.
Yeah, I mean, and in
Uh,
almost every crypto cycle, that's how it starts.
yeah.
Like it's like Ethereum didn't start out
Yeah,
as,
true.
this
To be
this
fair.
vehicle for stable coins. It popped off in 2017 because you could launch ICOs on it and raise capital on it.
Yeah. You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. Hey everyone, thanks for joining us for another episode of CFB Talks Digital Assets. I'm Ken Odeluga, Head of Content, and I'm joined as usual by the research team. Gabe, Head of Research, and Mark Pilipczuk, who's a Research Analyst. Happy New Year, guys. Nice to see you again.
Happy New Year.
Yeah,
Glad
happy
to
New
be
Year,
back.
you guys too.
And Happy New Year to all our viewers as well. We do appreciate you. This is a special time of the year because it is early enough in the year, 2025, to basically be in that sort of like liminal moment before everything starts kicking off in terms of more like the business cycle, really. I mean, crypto has a business cycle too. Of course, the markets never sleep, particularly crypto. So we've seen already some action which we can review. But it's also a particularly special 2025 as well, because of course we are waiting for the inauguration of a new president, or rather a new old president, right? And that has implications, some really specific pointed implications for crypto as well. So we're taking the opportunity to talk about that because a lot of it has been encapsulated in the research team's latest monthly report, the monthly market report, and this sort of key page at the beginning has a title, Santa Claus Rally Stumbles on Fed Outlook, which gives you a lot of information about what we've seen over the month of December. So Mark, Gabe, bring us up to date, please.
Yeah, let's wrap up December first. So December was obviously a month where I think we had a lot of momentum leading into it. But of course, we had the FOMC meeting in mid-month, which I think caused a little bit of volatility, a little bit of turmoil. And that's due to the forward guidance that they were issuing out, where they were kind of giving us a slower glide path. And we talked a lot about that in our outlook. This did kind of take the wind out of the sails for digital assets as well as risky assets across the spectrum. And ultimately, we still saw a pretty positive year overall for digital assets. A key theme that we kind of touched on in our latest QAR was maybe some catch-up trading on the altcoins, where we saw a lot of altcoin contribution in the fourth quarter. What that looked like in the end is that, you still had your blue chip tokens like your Bitcoin, your Ether, your Solana kind of leading the pack. And then some of these smaller cap altcoins didn't really gain too much traction ultimately over the past 12 months. So there's still room for upside. And I think for folks that are looking to add positions, certainly looking at catch-up plays is an option. You see that a lot in traditional markets. So I think we're still setting up for a constructive year for digital assets. I think there's going to be some short-term volatility, and we can talk more about that. But the report highlights a few other key takeaways. So I'll pass it over to Mark and see what those are.
So kind of wrapping up December, I think a big story, especially going into year end, was fund flows. We saw post-election, I mean, record flows into Bitcoin, but importantly, we saw Ether actually starting to catch up. And you look at the ratio of Bitcoin to Ether's market cap, it's about 4-1. Looking at the inflows, Ether actually ended up making up more as a percentage of the inflows than it does relative to Bitcoin's market cap. So we are starting to see that investor appetite come in for Ether. We saw it come in at the end of 2024, and it could benefit heavily from that altcoin catch-up trade going into 2025.
Yeah.
So looking at
Another
that,
thing on that is that if you look at the market cap of Bitcoin and Ether, like you just said, and you compare that to the AUM of the Bitcoin and Ether ETFs here in the US specifically, the ratio is off, meaning that Ether's spot AUM does not directly translate into its market cap relevance in relation to Bitcoin. The catch up is starting to happen. It looks like, right? I mean, we saw $2 billion in the month of December going to the Ether products out of a $6 billion month. $6 billion month. That's, to give you context, that's close to the record essentially of fund inflows for crypto ETPs. So it was a very strong month, and Ether almost got like a third of the flows.
Yeah,
yeah,
I wanted to let me just rewind a little bit, actually, chaps. Could you give us a sort of characterization, a rationale, if there is and something salient there, as to what the trigger was or what the impetus was for this? I mean, it's not an entire rebalancing, of course, in terms of the distribution, but why are we suddenly seeing this? What looks like the beginning of some sort of right sizing in terms of at least the perceived demand or the outcome seems to be pointing towards that. Why are we seeing this happening now?
I think a lot of it has to do with the potential for the regulatory changes coming up. Just over the last few years, we've seen a lot of the applications developed on Ether being either challenged outright. Uniswap with the IRS coming in with the ruling towards the end of the year, looking for that reporting requirement.
Yeah.
We also saw there wasn't a ton of clarity on things like stable coins, which is a huge use case for Ether. So that kind of lack of clarity and lack of future direction was probably, causing investors to be a little cautious until the election. Another thing we've started to see is the Fed started their easing cycle in September. And if you look at the Ether to Bitcoin ratio, that's kind of when it started to slowly make its turnaround, was in September.
Yeah.
Ether is seen as more of a risk-on asset, as with other altcoins in crypto. So when you start to see the first bit of easing, and the same thing when you saw the Fed do the hawkish cut, you saw Ether dramatically underperform Bitcoin on the
Yeah.
downside. So
Yeah.
that's playing into it a good bit.
Yeah. So this is brilliant, Mark, because we're obviously going to touch on a lot of those themes later on. We're going to talk about the regulatory outlook, specifically for ETFs, based on some content that was recently published on our blog. And of course, we're going to also talk about, it comes into it a little bit, but the Bitcoin basis, and well, you did mention the Ether basis. And also, that was something we mentioned in the Outlook episode as well. And so, we're going to bring you up to date on that as well. So, what we should do next, guys, I think a lot of people will be interested, and this will be serve them well to actually pull out some standouts in terms of performance, particularly for December, I guess. But we could also look at some of the year to date performances as well, because we do have that data, complete data to hand now. So obviously we'll start with the obvious. Bitcoin did manage to break, its 100,000 level, setting a new record, 108,000, and that was related to flows, I believe. But it's consequently sort of subsequently retraced. And I think it didn't turn out to be the strongest performer for the year in the end. And what was that? Or maybe you want to sort of put it in terms of indices. Who wants to take this?
I would say that there were altcoins that had higher 1 year performance figures than Bitcoin, and those, I would say, like it's still kind of concentrated. So I
Yeah,
would say the majority of altcoins are still not making new all-time highs, or that they haven't fully retraced and on a price discovery mode. But if you kind of calibrate the fact that Bitcoin's such a heavy weight in indices, in our indices, because of its market capitalization. It's translated into larger cap, heavier mega cap style tilts,
Yeah.
outperforming the altcoin indices that we see. In fact, like, for the month of December, we saw almost all the indices post negative results except for the DeFi index, which kind of goes into what Mark was saying about a regulatory rating. But on a year-to-date basis, it was the Ultra Cap 5, your institutional IDAX index,
Which
which
is
right now
constituted of Bitcoin and Ether. Yeah,
it
just
just
just a
holds
little,
two.
yeah,
It's
yeah,
Bitcoin and
yeah,
Ether that
yeah.
also, led. So it was definitely tilted towards these mega caps. And that's kind of like the key takeaway. Opportunities can be viewed in the altcoin catch-up trade. If you believe that, this secular run has, or if it is a secular run, it has more room to go, then looking at the tokens that have yet to hit all-time highs and having exposure to those is not a bad idea. But, we also got a sell-off in December for a reason.
Mm,
And
mm,
that was, I think, a lot of due to the monetary uncertainty, which we can talk about as well.
yeah. So let's, if we put it in terms of our key indices, we have a capitalization series. We also have a classification series. These are the key index series that we publish. Among the classification series, which tend to be a little bit more thematic, where would you be sort of like looking with interest in terms of potential opportunities that, the opportunities that you mentioned just now?
Yeah, for me, it's going to be within the DeFi index, I think. That's when I just look at the protocol fundamentals, that's where you're seeing most of the real revenue. That's where you're seeing, I mean, if you look at our infrastructure index, it has a weights towards all these layer twos. Most of the activity on those layer twos is coming from DeFi protocols.
Yeah.
So, like, if I'm looking for where blockchain seems to, specifically Ether seems to have found its like avenue for real world adoption, it's within DeFi, specifically like in the borrowing and lending segment. We now have Aave with over 30 billion in collateral in the protocol. We now have Uniswap trading comfortably $50 billion a week. We have competitors like Aerodrome coming in and trading over $10 billion a week on top of that. And we have, to kind of tailwind those, we have Kraken launching a layer 2 Inc.
Yeah.
We have integrations with, we have smart wallets. So you have Coinbase wallet, you have Kraken wallet, which has Inc. and isn't, well, it isn't a smart wallet yet. You can assume that that's coming. So you have much easier access for people to these protocols. You're not signing 5 or 10 transactions to trade anymore. You can do it in one shot on a smart wallet. All of these little frictions that get removed are going to ultimately make it cheaper for people to save and invest their money on chain versus the traditional ways they're doing it,
Yeah.
especially if you're in a country outside the US.
The underlying impetus, it seems to be like, I mean, I was formulating the question in my mind, it seems to be a combination of demand, adoption momentum, obviously price attraction, if you want to put it that way. So psychological market behavior. Or is there one of those sort of broad themes that is dominating? Also, of course, palpable improvements in transaction speed and throughput. That's a big factor as well. There's stuff that you can do now that you couldn't do 2 or 3 years ago. Clearly, that's a part of it as well. It seems to be like a coming together, a sort of like a confluence of beneficial factors that are bringing about this almost proto inflection point.
Two factors that immediately come top of mind for me is the user interface and the regulatory clarity, the regulatory uncertainty, we should say, that has lingered. So user interface has been relatively poor. I think a lot of these decentralized apps have had issues making it simple for people to pick up, their phone and log in, make it secure, execute transactions, know what they're doing. And that's where I think what Mark was saying about Kraken's Ink chain, with
Yeah.
having that type of, with the Kraken wallet, with all these things that they've been working on the team here, has been a really big step forward on the user interface side as far as getting ease of use to kind of interact and be on chain.
Yeah.
The regulatory side is still to come, but that's what I think markets are kind of pricing in. And I think that's why we're seeing kind of this appetite for DeFi. And the thing that you said earlier about demand, I think the demand has always been kind of clearly there. If you look at the stablecoin use cases, it's
Yeah.
been a very popular app, let's just say app or technologies to tokenize the dollar
Mm.
and transact in that manner. That's always been there. It's
Yeah.
just how do you get to the next level of adoption? And that needed, I think, those two other factors
Absolutely.
as well. Yeah, Mark, feel free to jump in
Yeah.
on that if you
Please.
think.
Yeah, no, you've totally got it right on the demand side. There's always been a demand to transact. There's always been a demand for consumer credit. There's been a demand for credit for investment. That's always been there.
Mm.
The problem is like at what price does the demand exist? And if your transactions are costing $5 and taking 15 minutes, at that price and that speed, the demand isn't there.
Yeah,
Yeah.
it's
So
not
by
ridiculous.
creating the easy user interface and creating those faster, transaction times, time to finality, at those prices, a cent per transaction, and at that speed, then the demand is there and might even exceed the demand for existing payment rails that we have.
Yeah, and we'll get onto this in a while, but clearly we're starting to see some of the consequences of that perceived uplift in demand, broadly speaking, filtering through the institutional participation space with futures and obviously markets in general, and spot markets. I want to know where you guys see this going. I mean, I've always felt that the flippening was a bit of a joke, in terms of, I think, maybe I'm starting to rethink that, but I do think it's some way off. But am I wrong? I mean, is it possible we could see that sooner than even people like me expect?
Well, the great thing about this stuff is it has a lot of volatility in it, as any tech investment does.
Yeah.
So, I mean, Ethereum is about a quarter of the market cap of Bitcoin, and if you look at historically, or even if you look at kind of implied volatility and extrapolate that out a bit, a 4x move isn't out of the question. Now, the thing is, Bitcoin can move against it, and then it can
Yeah.
it might not happen.
Yeah.
But I think you can start to see the gap close. If you just look at Bitcoin as kind of the store of value and you look at gold's market cap versus, say, equities, the
Yeah.
store of value does have a large market, 20 trillion versus 100 for equities, 1 to 5. But equities is clearly the bigger space just because of what they offer. They've got the cash flow.
You could argue that like equities are store value as well. Demand. I mean,
Yeah,
it's
yeah.
Yeah.
kind of how you've been sold equities at the retail level is this is your savings vehicle. So if
Yep.
you think of like the disruptive potential of Bitcoin, like what if it just gets sold at that same narrative in a sense that this is protecting your purchasing power for the future? It's a vehicle and it's volatile, so you have to be responsible with it, meaning that you have to size it appropriately. But that's you know a thing to kind of combat that. One thing that I want to jump to is we're talking a bit about the regulatory stuff. Ken, you wrote an excellent blog talking about crypto ETFs here in the US. What's the landscape going to look like? And I think you start off the blog mentioning, this old doctrine.
Yeah.
So, I in this old doctrine, you outline it as kind of like I think it wasn't really like a proactive approach, a reactive approach. Anthony Scaramucci likes to use I think the legal term, which is the legal standard of arbitrary and capricious.
Yeah.
So, they
Which
kind of
is
put
that's going to
themselves,
be ringing in this SEC's ears for many decades to come,
yeah,
isn't it?
which I like that a lot. And in the ETF space, I guess you could say, the way they were kind of fighting certain actors or certain people in the industry. You had the grayscale case over here. They decided, okay, well, maybe the standardized futures market's enough, and they were kind of forced in one way or another because there was these standardized CME futures which we set the benchmarks for. That they were kind of forced into a corner in the end with Ether and Bitcoin. But
Yeah.
what's the old doctrine in your eyes, and how do you see that changing?
Yeah. So, I mean, it was just a kind of like a term to capture, I guess. The SEC doesn't have a doctrine. We call it that, but it's really a term to capture basically how things transpired, how we managed eventually to get a Bitcoin ETF and eventually an Ether ETF trading in the United States on US exchanges. Because the SEC, for rightly or wrongly, had what we can characterize as deliberately opaque sort of like stance towards regulation. Now, there are actually some good reasons behind that. Clearly, we have, within the securities laws, the exchange laws, investment company act, and so on, all related laws. Essentially, these laws originate from the 1930s. There have been many amendments since then, but generally speaking, the main tenets of them originate from the 1930s. So it's very difficult to apply, to copy and paste these principles onto what we're seeing happening in blockchain economics and cryptocurrencies and coins, tokens, digital tokens. So that's one justification for the SEC to adopt that approach. But on the other hand, it has severe downsides, and we all know them only too well. So essentially, what it's characterized by is just the practice that emerged from the SEC over the years that I guess eventually culminated in the approval of an ETF that invests in crypto. Of course, that was Bitcoin. And as you say, Gabe, it had to be forced into that corner to actually enable that, because it never laid out how institutional participants would actually come to that stage. It never laid out clearly how it expected institutional participants to come to that stage. It had to come to that stage by trying and failing and inferring, what the SEC wanted to see, and then going from there. And then in the end, of course, as we know only too well, it came down to a legal decision that forced the SEC's hand, and it had no choice but to, So I think that's the part. That's the old doctrine. Now, the reason why I wrote this article is because clearly what we're seeing is, with the advent of the Trump 2, the second Trump administration, and his well telegraphed stance on crypto, and what we know about his incoming financial leaders, the SEC and the Treasury. Of course, these people haven't been confirmed. They haven't even had their confirmation hearing. So we don't know whether this is absolutely confirmed that they're going to actually be in those positions. But it's quite likely we will get a new SEC chair, and he will be someone who's pro crypto, as he's been trailed. Institutional participants are anticipating that it'll be a lot easier to get digital assets of many more kinds beyond Bitcoin and Ether into ETFs. But I think what the article does is try to examine how likely we are to see that optimism realized in the mid to I guess near to midterm, because there's a lot of scope for caution. I'd love to hear your views, chaps, as well.
Yeah, I was gonna say I was particularly interested in the part in the article where we talked about some of the filings that have been put out there
Yeah,
since the election or since the ETH ETF. We have this Solana and we have XRP and talks of Litecoin now going out there.
yeah, and Hedera as well, if I'm pronouncing that
Yeah.
correctly.
So with filings like those, they all have, a first approval deadline and everything. Do you think it's likely that we would see them essentially those go through as they are, or we would kind of wait for a more comprehensive framework, then they would come back and then kind of
It's,
refile
it's
everything? Is that
really
what we're kind of
really
looking
a
at?
great point. I mean, it's so difficult to predict. I mean, let's let's let the guy get his foot under the table. But I mean, we'll talk about this Paul Atkins, who's well, I think, as I said in the last podcast, we can't even call him chair designate yet, because there's no confirmation hearings. But I think it's pretty likely he's a former commissioner. He's a former staffer. He's got a long track record of in the SEC and around the SEC, and sort of like in regulation in general. He's a good pick, I'd say. But and also, of course, he's pro crypto. So the main problem, I think, guys, and then I'll hand it over to you, is that you, although you can have a chair who's pro crypto, the actual apparatus, the legal apparatus, the rule making apparatus, is simply not pro crypto yet. And I guess the key point to consider, I think, and I want to hear what you guys think, is how quickly that underlying apparatus, the legislative framework, and of course the SEC's internal rulemaking, which has a major impact, how quickly can that move to actually sort of like realize some of these hopes of these issuers, do you think?
And I think that, like, you ask yourself, what does a what does a pro crypto regulatory regime look like? And for the SEC, I certainly think it is taking a more proactive approach to setting guidelines and defining clear paths or standards that need to be met in order for something to be designated under, irrespective like security issuance or something like that. And then on the CFTC side, they have they should have their bars, their standards set as well. And that is, to me, kind of like the difference between what we've had in these past few years to what we're hoping to get in the next few years. And that's a proactive regulator, someone or a group of individuals who see the value in the innovation, don't want to stymie it. But at the same time, I think they respect the fact that consumers need to be protected and there needs to be some standards. But the kind of reactive approach that was being used before certainly wasn't working. It ended up backfiring ultimately with
Yeah.
the SEC and Gary Gensler because they were put in that corner.
Yeah.
The thing that I want to just kind of wrap up quickly on is
Mm.
this thing that you talked about in the article, which is the use of reference rates. We have these reference rates that use our methodology on these other tokens besides Bitcoin and Ether.
Yeah.
I
Yeah.
think maybe go into that a little bit because there's certainly some things that we should highlight as far as how that translates into the derivatives market. How does that help market manipulation and kind of resistance against those bad actors in the marketplace?
Yeah. Yeah. So for this, the reference rate piece is critical, I think, because I think this is possibly the one point of optimism that I think is a little bit overestimated on the part of some issuers by the looks of it. Because it seems to suggest that if we don't have a regulated reference rate, which arises out of course, the primary contract market, which is, of course, the CME group, and then what that enables is, of course, is CFTC oversight and surveillance, total regulatory look through between the CFTC regulated side, which is, of course, the contract market, and the spot side, which is still, let's say, developing regulation. You have that enabled already. That is consumer protection, market integrity, all sorts of benefits, which I don't think the SEC is likely to put aside very, very easily, right? So if you accept that, then basically you need to accept that if you don't have a CME CF index, which is basically a reference rate that is constructed, devised in partnership between CF benchmarks and the CME group, or something that is accepted of that nature, equivalent, there's nothing that exists at the moment of that framework, then you're not going to get basically an ETF because you know you need a market, a CFTC regulated market to actually have this that surveillance, the standard of surveillance that we've got used to, right?
Just give like some background for the listener. It's the way the reference rates get constructed here is we have basically we have agreements with constituent exchanges.
Yeah,
They give
yeah,
us their order books. And since we know that digital assets trade on various venues in a decentralized manner or a centralized manner, but ultimately, there's not just one exchange, you need to understand the entire market. You need to get a picture of the market, and you want to have that picture be as, let's just say, institutionally filtered as possible or cleanly filtered. So you want good quality data. And that's what we do here at CFB, CF Benchmarks. What I was going with that is the reference rates that we provide the CME group or that we work with in conjunction with the CME group for their futures is actually their spot volume. It's spot inputs. So
yeah,
you're getting, the spot order books, those prices feed into the calculation of a singular price, which market makers, OTC desks, prime brokers, retail now with, you have the Bitcoin Friday futures, all institutional players now have like a singular price point that's bringing all these different venues together. And so when you think about like a regulatory standard or a bar, it's kind of like, I think hopefully that they can appreciate like they did before with the Ether paper that we wrote to the SEC, that note that we wrote to the SEC for the
yeah,
Ether ETF approval. They can appreciate the fact that there's a team here, at CF Benchmarks that's working hard to create robust
yeah.
frameworks for
Ju- ju-
pricing
ju-
data.
Just to
So
wrap that up, actually,
that's my
just because
rant
you
on that
you
one.
touched on something, Gabe, that we can't forget. a critical component in that surveillance infrastructure is, in fact, the CME CF constituent exchange criteria. That is a codified set of rules and standards that all spot exchanges that contribute their data to our reference rates must meet. And they're constantly reviewed as well. They're regularly reviewed. And if they fail to meet those standards, then they're removed from as a contributor to those reference rates. As a regulated benchmark administrator under EU and also UK BMR, benchmark regulation framework, we have to sort of abide by those standards. So in turn, consequently, all participants that we work with have to abide by the same standards as well.
Yeah.
You can't overlook the importance of that. So yeah, as I say, I struggle to see the SEC saying, well, yeah, we don't need surveillance sharing, we don't need a DCM, a designated contract market. Anyway, it's a massive area, of course, and we could spend far too long in it. Thanks a lot for raising it, Gabe. To read the article and also, of course, to read the market monthly, do visit cfbenchmarks.com and go to the Insights tab. And for the market monthly, look at the research item on the menu. And for the article, look at the news section. So
Don't forget to subscribe.
Don't forget to
That's the
subscribe,
easiest
please.
way.
Yeah.
That's your
Then you
AI.
don't have,
That's
yeah,
your old
exactly.
school AI agent is
Yeah.
the subscribe box.
So, okay, guys, as we round this off here, let's do a little bit of a round table and try to throw things into the pot in terms of what are the things top of mind for each of us. So maybe I'll go to you first, Mark. What are you particularly keeping an eye out for in the first few weeks and months of 2025?
So I have been spending almost more of my time on AI than crypto lately. The AI, all aspects of the AI trade, there's a few things going around. So there's the agents, there's the launch pads like virtuals and LLM wrappers that we're seeing. And what's going to be interesting is to see how that develops into the year with especially some of these more advanced models, these chain of reasoning models from OpenAI, O1, and then now O3, once people start getting API access to that. The other big area that crypto and AI are going to kind of intersect is going to be on that deep in and hardware side, I think. So I'm going to be watching protocol revenues on chain, especially with the new generation of GPUs that are now available to consumers starting at the end of the month.
Yeah.
I'm going to want to see how those make their way for rentals, how they perform for model inference, and what the kind of cost structure looks like versus traditional data centers, and see if more people are pushed into that with the newer hardware.
Yeah, and by the way, guys, we talked about deep ins were a big part of the secular themes that were spotlighted in the Outlook episode. But Mark, I want to come back to you with something on that because clearly, Mark, you are an early adopter. You are not like the average. If there is an average crypto consumer, there will be in time, but you're certainly not that. So I want you to try, succinctly to characterize what is the sort of zenith of what could be possible when this whole AI agent piece gets fully formed. What will you be able to do? What are you looking forward to being able to do that you are not able to do now, or you can only do with difficulty?
So the thing that the kind of end state that I'm looking for are when we get to the AI agent to AI agent interaction.
Okay.
And like on a B2B thing.
Yeah.
So if you think about it, your business needs to warehouse some data. Your AI agent's going to go get quotes. Some other AI agent is then going to quote you. They're going to actually buy the storage. And then we can essentially have an economy that kind of works on its own, where you'll be able to do as the founder of a company. Right now, you have to go in, you have to hire a 20 or 30 person team when you have an idea and spend millions of dollars in venture funding. We might get to a point where the guy with 50 grand or 25 grand can spin up a whole bunch of these AI agents, and then they can start a company and maybe start to compete with some of these companies that are getting funded by places like Y Combinator or some of these bigger venture funds.
Yeah.
So it'll really democratize access to starting companies.
I was going to say about that democratization point, like, do you think that that's the disruptive potential from like a barrier of entry? Like you knock down the barriers of entry so low that you can get smaller idea folks to launch projects quicker and faster with AI agents?
Yeah, and that's kind of been like the whole reason I've been bullish on AI, even before the agents, when it was just the LLMs, like getting your
Mm.
software development costs down. It's starting to get to the point where without access to institutional money, you almost can't start a company that's competitive with some of the mega cap corporations we
Mm,
have.
The
mm,
gates of
So
venture capital.
yeah,
Yeah. Well,
yeah.
and then you got the AGI story. So, Sam Altman, I think, is he teasing? Is he saying, is he committing to AGI this year? Or did he just kind of say, we think we can get it this year?
he seems to be teasing that internally they have something. So we'll
Does
see if
that
that gets
change the
announced
AI
this
agent
year.
Mm,
trajectory if they have AGI? Is it going to
yeah.
be fast?
Yeah, it would probably speed up the adoption if the less input from humans the computers need, the better
Mm,
for this to work.
Imagine
yeah.
yourself running a business and you look at your phone, you're like, oh, I got a new vendor.
I
Oh,
I
mean,
didn't have to lift
I
a
just
finger.
I just signed a
I've
contract with, oh, okay, never mind. We nullified that contract
I
too.
mean, I saw an example of one agent, and there's this there's this decentralized AI protocol called BitTensor, and what it is it's a network of essentially they're called like subtensor networks where you're running LLMs, and then to mine the coin, what you do is you provide inference services, and then you pick as the end user, you pick what model you use, and we'll pay a bunch of GPUs to run it. But I saw an AI agent on one of the subtensors who's fine tuning the model and earning revenue. And they, when I looked at its salary, it's about half a bit tensor a day. It's earning the equivalent of $85,000 a year as an
Wow.
AI agent. So somebody is
That
running an
actually,
agent, and a computer is now earning more than the
there you
median
go.
wage in the
This is
US.
we are there,
Yes,
guys. We
there
are there. But there's I wanted to one thing. What I wanted to actually ask you, Mark, is clearly great fuel for the doomsday scenario merchants. Crypto, AI, and of course the safety concerns. AI agent to AI agent interactions. There's all sorts of like scope for nightmare scenarios to emerge. Clearly, we don't necessarily subscribe to such trains of thought. But what kind of safeguards, as an informed sort of participant in the space, what kind of safeguards do you want to see to actually sort of like remediate those risks?
Yeah, that's a it's a tough one because of what they can do. It's how
Yeah,
do you almost not slow it down, but how do you protect like
yeah,
legacy industries, or how do you stop this from totally going rogue and just putting all of us out of jobs? And I think a lot of that's going to come down to how does it integrate at the end of the day. I almost don't see it being a thing that's like all of us are integrating like or dealing with on a day-to-day basis. I really see it being more of a B2B solution,
right.
or with DeFi, like on the back end, a market liquidity solution. So we're fragmented across chains, we're fragmented across even layer ones versus layer twos. And there are some bridging solutions on chain, but this could be a good complement to that to come in and help bridge some of that gap. So you're going to probably see some type of regulatory framework for how these bots are able to deal with some of the liquidity, especially if they're going from centralized exchanges to decentralized exchanges. There's probably going to be something there.
Yeah, we don't, and we're not going to even go to regulation because I just don't know how
Yeah.
that's going to work. So, Gabe, moving around the table to you. Did you want to talk about 13Fs or do you something a bit more broader?
Yeah, I'll start us with 13Fs. That's what's kind of what I'm mostly focused on in the initial stage of the year. We had a call for 2025 that the allocation distribution for these spot ETFs is going to shift. We're going to see more advisors adopt them or allocate to them in their client portfolios, which is shift the pie breakouts from, let's just say, around 30% to over 50%. And we call that the wealth advisor migration for 2025. So we're now in early January. The 13Fs have deadlines or quarterly deadlines, 45 days after each calendar quarter. So we're going to start to see some of that information to drip in the next few weeks. And I suspect that, the Q4 2024 data, which will capture some of that post-election, movement in the advisor community, will be reflecting or should be reflecting some changes in the allocation pie charts. So I'm going to be following that closely. I want to see if our call for a 50% breach on both ETFs on both assets is met. And other than that, I think the folks at the Bureau of Economic Research here are going to have to figure out how they want to account for, wage income from AI agents. That's probably what I'll drop on the podcast. If we
It's
got
going to be
if we
amazing.
got a bit tensor agent making more than the median wage, we had farm payrolls, non-farm payrolls, right? And then we're gonna have worker payrolls,
There's
non-farm payrolls,
non-human
AI
payrolls.
agent
Yeah, AI
payrolls,
payrolls.
and see
Yeah.
how that all gets broken out.
Yeah. But Gabe, how soon? I mean, I think we said the next, I mean, the bulk of the next set of 13Fs. I think you made the point that they're not all going to come in mid-February, but a lot of them will come in mid-February. They'll be trickling in before then. But what does it look like in terms of the outcome as regards 13F, particularly the distribution picture for these crypto ETFs beyond the sort of like hedge fund space, which dominated the early adopters in 2024? What kind of distribution, what kind of percentage are you looking for in February to actually give you some confidence that your hypothesis was correct?
I would say that that's a good question. I would say that a nice initial move towards our goal of 50% is probably going to be reflected early on. Let's just say after the election, I think we get a nice bump. Advisors are probably more confident, and then I wouldn't be surprised if, depending on how hedge funds behave, depending on how price action goes throughout the summer months into the latter half of the year, it could get a little bit bumpier to get to 50. But if I see, some more adoption, we're already starting to see RIAs being kind of like the first ones. The wirehouses, the big banks are a little slower. I think Morgan Stanley was the one that headlined in Q4 of 24 as being a firm that is, it's a major bank wirehouse that allowed their private clients to act on a non-discretionary basis. Now we're going to see, I think, just more RIAs continue to kind of adopt it specifically for the demographics that are, I think, younger, that are interested in cryptocurrencies. And then you're going to start to see some of the banks, I think, follow them. And that's where you get, I think, the real shift. And that also kind of feeds into our call to have more fund flows for 2025 than
Yeah.
in 2024, which is, we won't
Yeah.
complain about
No,
2024 numbers.
not at
Those were
all.
great.
Not at all. I mean, guys, it's exciting, especially the way you put it, Gabe. It's truly exciting to, I want it to happen as soon as possible. um, be slightly disappointed if it doesn't, but of course, it doesn't necessarily mean it's off the cards for perpetuity. It isn't. It's just a slower pace potentially than the outlook. Aside from that, on my side, what I'm looking at is obviously, this regulatory outlook, broadly speaking, how Washington plays out and the consequences of that as regards regulatory stuff broadly, and of course ETFs. ETFs are our thing here at CF Benchmarks in particular. I'll be keeping an eye on that two tracks idea. That article that we mentioned postulated the potential for a two-track review process in the medium term as regards these ETF filings. As you said, Gabe, we've seen a huge spate of Solana filings, XRP filings, Ripple's XRP, and of course a few wildcards like Litecoin and also Hedera. Maybe I'm missing something as well. Basically, everything but Bitcoin and Ether, which there's a few Bitcoin and Ether filings there. Now, the point is, I expect those Bitcoin and Ether filings, there's a few portfolio filings. I mean, there may be portfolios holding initially just Bitcoin and Ether, but those should actually get approved pretty quickly, I would expect. But it's these novel, what I've called the novel digital asset ETF proposals. Your XRP, which is basically still in the middle of a court case. That's unresolved. Your Litecoin, which I don't think has an index, hasn't got a CME-CF index. So if we're right that you do actually need to see these things as part of the surveillance infrastructure, that's a bit of a problem. XRP does have a CME-CF index, by the way, and Hedera, which is seems a total wild card. And then, of course, you've got the sort of like the staking aspect, which the SEC has made clear it doesn't necessarily feel comfortable with. On the other hand, you've got the in-kind piece. At the moment, all crypto ETFs are created and redeemed in cash. That can be resolved very quickly because I think the reasons for that do seem particularly quixotic or chaotic, if you want to use the Spanish pronunciation. And, I think that could easily be resolved. But this is all speculation. So I'm going to be speculating with the best of them on that side of things.
Just one minor house cleaning item before we close out. We do have a Litecoin CME reference rate.
Oh, we
Yep.
do. I beg
Find
your pardon.
all
Yeah,
of our
yeah.
reference rates in the CME CF cryptocurrency pricing
Yeah.
products online
Mhm.
at
Yeah.
on our website under products.
Yeah.
Or group there. So
Yeah.
we do have Litecoin covered.
Mhm.
There's
My
a
mistake.
full suite of other ones there to go check out. And
Yeah.
that was just the
Yeah.
last thing.
Yeah.
Another great great one
sorry,
to
go.
watch for the filings.
Yeah.
The Franklin Templeton, that Bitcoin Ether ETF, that's approved. So we've got that's coming
Yeah.
through. And then I'm
That's
going to
a
be
basket.
watching. Yeah, it's a basket. And then I'm going to be watching the Bitwise 10 conversion to an ETF. I want to see what happens.
Yeah. That's going to
could-
be interesting.
That's
Yeah,
true.
that
Good point.
Yeah, either way it goes, it's going to have pretty big implications for us.
Absolutely. Yeah. Because obviously there's a few coin tokens on there
Mhm.
that fall into the categories that I mentioned earlier.
Yep.
But there's some which don't fall into those categories, right? So yeah, the way that goes is going to be very, very
Mhm.
instructive. Guys, we're at time, so appreciate those thoughts and insights and brilliant discussion as usual. If you who are watching and listening also appreciated it, you need to go to cfbenchmarks.com, research and insights, and also the news section to find the content that we've been sort of discussing in this episode. If you enjoyed the podcast, Spotify, Amazon Music, Apple Podcasts are the places you need to go. Don't forget to like and subscribe. We'll see you again for another episode of CFB Talks Digital Assets.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.